What's up, everybody? My name is Joe Brown. This is the Heresy Financial Show, and today we are talking about the real reason why the Federal Reserve is jawboning so much about raising interest rates. Despite the fact that they've only raised rates by 0.25%, they keep on coming out and saying, hey, we'll raise by 0.5%. We'll raise by a lot. We're going to get to 1.9%. We're going to get to 2.5%. They keep on talking about it. Very little action behind it. So today we are going to talk about the real reason why they're jawboning about it, and it has to do with what they plan to do next time things crash. Ready? Let's dive in. In 2016, 2017, 2018, the Federal Reserve was raising rates. This despite many economists saying the economy was not strong enough in order to have the Federal Reserve raise interest rates. Now, you know my opinion that the Federal Reserve should not be controlling interest rates. Yes, the Fed funds rate is their own, so that's technically not manipulation, but they should not be involved in QE, QT, anything regarding free market rates. They should just respond to whatever the market is setting, respond to the overexpansion of the money supply, the under-expansion or the contraction of the money supply, the savings pool being abundant or not abundant at all, the environment, the risk. It should all be just left to the free market, again, without fractional reserve banking, especially backed up by a central bank. But that's a story for another time. The Federal Reserve was raising rates, even though most economists said they shouldn't be raising rates that much. And they kept on going, and they kept on pushing it, despite many people saying not to, especially political pressure. You may not remember, but during 2017 and 2018, there was a lot of political pressure on the Fed to stop raising rates. Pretty much every single tweet by President Trump at the time was that the Fed, Powell, was trying to crash the markets by raising interest rates, and he was pressuring him, stop doing it, stop doing it, stop doing it, until finally, at the end of 2018, when the stock market was crashing in December of 2018 and wouldn't stop crashing, kept falling and falling and falling, finally the Federal Reserve stopped raising interest rates, and they said, okay, we're not going to raise interest rates anymore. And that was when the market bottomed. And then, just a couple months later, in September of 2019, they had to drop interest rates and start adding assets to their balance sheet again, reverse QT to go to QE again, because the repo market blew up. Again, the economy couldn't handle the tightening. So now that we are in a position that is arguably much worse and much more precarious, and the growth is way more fake than the growth was in 2016, 2017, 2018. Even though there was a lot wrong with the economy then, there's a lot more wrong now. A lot of zombie companies, a lot of massive buildup of debt, unproductive debt, a lot of industries that exist solely because of the massive expansion of the money supply. This is not a situation where you want to be tightening, where you want to be, as a central planner, be constraining the money supply and potentially shrinking the money supply, because inevitably you will result in overcompensating that way and pulling the rug out from underneath the fake economy. It's like a Jenga tower held together by bubble gum, and you open up a leaf blower at it. As a central planner, that's not what you want to be doing. Now, as a free market participant, of course I want it to all fall down, because then if free market participants are able to build it back up again, you're going to build it back up in a much safer, more solid way, with a strong foundation built on savings and real wealth, not on debt and an artificial expansion of the money supply. However, right now they are tightening. They are slowing down, or they stopped their asset purchases. They're talking about selling assets in the future. They're talking about raising the rates faster. And the question is, why? Because the economy is way worse off than it was before. Why are they doing this now? Well, it's because they know another crash is coming. But the question is, why are they jawboning so much about being more aggressive when they're not actually being aggressive now? We've not seen inflation this high in 40 years, and the Federal Reserve is still only raised rates by 0.25%. And they're still only saying that by the end of the year, the most aggressive place they'll be is maybe 2.5%. Now, they can't get that high without crashing the economy, but they're not even close to the inflation rate, which is 8% right now, officially. And we know that the real real inflation rate is much higher than the official inflation rate. And so why are they talking a big game without backing it up by any real action? It's because the market responds to this. We've seen a massive spike in the yield of 2-year treasuries, of 10-year treasuries, of 20 and 30-year treasuries. We've seen the market respond to this and interest rates have risen because that's what interest rates do. When investors realize that the base interest rate is going to go up, anything along the end of the curve is going to go up. You're going to have the market front run the Federal Reserve actually doing that when they say that they're going to do it, because you want to front run that. You don't want to get caught behind it because then you'll lose money. So the market has started to respond to that. So just by the Federal Reserve saying that they're going to get more aggressive has caused the market itself to get a lot more aggressive. Now that that has happened, now they have some capacity to bring it back down when it crashes. And that's the whole reason that they're doing this. Because when it starts to fall apart, if the Fed funds rate was still at 0, then they'd be pretty screwed. If the Fed funds rate is at 1% when things start to fall apart, at least they can bring it down by 1%. At least then they can say we were able to bring down the short end of the curve, and now we're also going to bring down the long end of the curve. It won't look like so much like a desperate attempt to just bring down the long end of the curve with yield curve control without the short end of the curve already being at 0. If they've let it come up to, let's say, 1%, 1.5%, 2%, wherever it's at when everything starts to fall apart, they can pull that down and they can say, along with bringing interest rates here down to 0, we're also going to pull, let's say, down the 30-year, where we want to target 1% on the 30-year. And so they're going to be able to have a softer entrance into yield curve control if they allow the Fed funds rate to go up above 0% between now and then. So that's the only reason. They're being aggressive with what they're saying so that the market will push the yield curve higher so that they have a little bit of room to pull the federal funds rate down in the next crash. And that's the only reason, to try and maintain some confidence in their abilities to manage the economy, which they have no ability to manage the economy. They only have an ability to mismanage the economy. But that's why they are doing this and why they're being more aggressive with their words instead of their actions, because the long end of the curve is still high. And when it comes time to engage in another rescue, another bailout of the economy, they'll be able to put full yield curve control on, bring that whole yield curve down, and target interest rates with their asset purchases instead of what they've been doing before they started tightening or stopping their asset purchases, which was targeting a specific dollar amount of purchases and let interest rates do whatever they do as a result. Fundamentally different. As always, really appreciate you guys. Thank you so much for watching. Have a great day.